The silver market officially broke today. Not cracked, not bent, broken. And what I am about to show you is not a prediction. It is not a theory, and it is not clickbait. It is a live autopsy of the most important commodity market in the world, happening right now in real time, while most Americans are still staring at their stock tickers, wondering why their tech portfolio feels a little off today. Here is what nobody on television is telling you. While the price on your screen says silver costs $85, buyers in Shanghai are paying $93 for the exact same metal. That $8 gap is not a rounding error. That gap is the sound of the entire Western financial architecture beginning to fracture at its foundation. And if you do not understand what that means for your savings, your purchasing power, and your family's financial future, you will, by the end of this video. We have been warning about this for months. We have told you that the suppression of the silver price was mathematically unsustainable. We have told you that the paper contracts traded on the commodity exchange in New York were living on borrowed time. And we have said repeatedly that when physical reality finally reasserted itself, the move would not be gradual, it would not be linear, it would be vertical. Today is that day. Do not look at the Dow Jones Industrial Average. Do not look at the NASDAQ Composite. Look at the silver market, because what is happening right now is not a normal trading session. This is a liquidation event. This is the moment when the paper world and the physical world stop agreeing with each other. Sure, and the consequences of that disagreement begin to ripple through every corner of the global economy. But do not let the green candles on your screen fool you. The price you see on CNBC or Bloomberg right now is actually the least interesting number of the day, and I will tell you why. Because that price is a lie. While the ticker says silver costs $85, a completely different reality is unfolding at ground level, at the actual point of sale, where real human beings are trying to buy real metal with real money. We have received reports from major precious metals dealers across the United States and Europe, and the message from every single one of them is identical. It is short, and it is alarming. Nobody has any silver. Not a warehouse problem. Not a shipping delay. Nobody has it. Try to buy a single silver coin today. Try to get a 1-ounce American Eagle or a Canadian Maple Leaf at the spot price. You cannot. Dealers are reporting delivery delays of up to 8 weeks. 8 weeks. 2 full months. Do you understand what that means? That is not a delay because a truck broke down. That is a production failure. That means the mints themselves cannot get the raw silver blanks they need to strike coins. These dealers are selling you metal today that they can only hope to deliver to you in March. What you are witnessing is a physical default at the retail level. The buffer that normally exists between the wholesale market and you, the end buyer, has been completely emptied. It was drained in the last 48 hours. And what happens to price when supply disappears? It decouples. The premium explodes. We are seeing premiums of 30 to 40% above the spot price at retail. Right now. Today. And this is the moment when the paper market becomes irrelevant. The banks can push the paper price down as far as they want. They can print billions of dollars worth of empty contracts on the commodity exchange and short the market into the ground. But they cannot print physical metal. They cannot manufacture a single silver coin out of thin air. When you walk into a dealer and he tells you the price is $40 per ounce over spot. That is the price. It does not matter what your smartphone says. What we are experiencing right now is a bank run, not on a commercial bank where people want paper currency. This is a bank run on the resource bank. People want to trade their worthless paper for real, tangible, upholdable assets before the window closes. And that window, ladies and gentlemen, is closing right now. The 8-week delivery delay is your warning signal. If that becomes 12 weeks, the market freezes entirely. Then there is no price. Then the word becomes unavailable. Now let me show you the engine driving all of this. Because to understand why silver is exploding, you need to stop looking at New York and start looking at Shanghai. We obtained the closing data from the Shanghai Gold Exchange. While New York was still asleep, China finished its trading day, and the price they fixed is the most dangerous number in the global financial system right now. Silver closed in Shanghai at the equivalent of $93 per ounce. Let that settle in. In New York, the price is $85. In Shanghai, it is $93. That is not a small discrepancy. That is an $8 spread. And in a world of high-frequency trading where algorithms fight over fractions of a cent, $8 is not a gap. It is a black hole. It is a vacuum pulling matter toward it with irresistible force. Here is exactly what is happening behind the scenes. Imagine you are a large global bank. You see silver sitting in a vault in London or New York for $85 per ounce. Simultaneously, you see buyers in Shanghai screaming for metal and willing to pay $93. What do? It is the easiest trade in the world. You buy the metal in the West. You load it onto an airplane. You fly it to Shanghai, and you sell it for $93. Even after paying for transportation and insurance, you are pocketing a risk-free profit of roughly $6 per ounce. That trade is happening right now, in this very second. Every available ounce of silver in London and New York is being loaded onto pallets, wrapped in plastic, and shipped east. The result is that Western inventories are hemorrhaging. The commodity exchange in New York, whose stockpiles were already at historic lows, is being vacuumed out to feed the premium in Shanghai. We are witnessing a historic transfer of power. For decades, the silver price was determined in London and New York through paper derivatives. China was the price taker. They had to accept whatever price the West dictated. But today, that dynamic has completely reversed. China is now the price maker. They are bidding the price higher because they need the physical metal for their solar panels, their electric vehicles, their military applications, and their strategic reserves. New York is now just a passenger. The vertical green candles you are seeing are only the West's desperate attempt not to fall too far behind, and the game is not over until the prices converge, which means even if the price in New York pulls back tomorrow, the floor is set in concrete, because the cheaper silver gets in the West, the greater the incentive to ship it to Shanghai. The magnet pulls everything toward it. But why is China paying such a massive premium? Is this speculation? No. This is something far more serious. This is industrial panic. Forget the speculators for a moment. Think about the manufacturers. Think about a solar panel producer in Shenzhen, or a battery gigafactory like contemporary Amperex Technology Company. For these companies, silver is not money. Silver is a critical raw material. Without silver, the assembly line stops. For decades, the global economy ran on the principle of just-in-time inventory management. You ordered material exactly when you needed it. Warehousing was expensive. Efficiency was everything. But that era died. The just-in-time model is dead. It has been replaced by the just-in-case model. Put yourself in the position of the purchasing director of a major automobile manufacturer. You need silver for the electrical contacts in your electric vehicles. In a $50,000 car, the silver content might be worth $50. The price of silver is almost irrelevant to your profit margin, but availability is existential. If you have no silver, you cannot build the $50,000 car. The factory stops. Revenue stops. Our shareholders revolt. So what do you do when you see global inventories declining? Do you wait for a better price? No. You panic. You buy everything you can get your hands on. You do not care whether the ounce costs $30, $90, or $150. Price becomes irrelevant. That is the definition of inelastic demand. That is exactly what we are observing in China right now. Industry is stockpiling. They are building strategic reserves to secure their production for the next 12 to 24 months. This is not trading. This is survival. A speculator sells when the price rises to capture gains. An industrial buyer buys more when the price rises out of fear that tomorrow there will be nothing left to buy. We have reports of Chinese companies signing contracts directly with mine operators in Peru and Mexico, bypassing the exchanges entirely. They are purchasing the metal at the source before it is even refined. That means this silver will never reach the open market. It disappears directly into the dark storage facilities of industry. That is the floor I have been telling you about. You can shake a speculator out of a market, but you cannot shake a buyer who needs the metal to keep his factory gates open. And now let us talk about the math, because many of you are looking at $85 and thinking you have missed the move. I am telling you that you are making a fundamental error in measurement. You are measuring the value of silver with a broken ruler. You are measuring in dollars. But we know that dollars are in the process of dying. Measuring a table with a rubber band that is constantly stretching makes no sense. The table appears to get longer every day, not because the table is growing, but because the rubber band is losing its shape. To understand the true value of silver, you need to compare it against the only standard that has held its meaning for 5,000 years. Gold. Gold is the anchor of the financial system. Look at the gold price. It is trading today above $4,600. And now look at the gold to silver ratio. This is the most important number for any precious metals investor. Geologically, there are approximately 15 ounces of silver for every ounce of gold in the Earth's crust. Historically, from the Roman Empire to the founding of the American Republic, the pricing ratio reflected that geological reality. 15 ounces of silver equaled the value of 1 ounce of gold. But in the age of paper market manipulation, that ratio was distorted. It rose to 80, to 90, even to 100 to 1. That meant silver was being treated not as money, but as cheap industrial scrap. However, today, reality is reasserting itself. The ratio is collapsing. We are now at approximately 54 to 1. But what happens when we return to historical norms? The math is simple. Take the current gold price of $4,600, divide it by the historical ratio of 15. That gives you a fair value silver price of $306 per ounce. At $85, silver is not expensive. Silver is on clearance. It is trading at a 70% discount to its true monetary value. The $100 mark we are approaching is not a ceiling. It is only the first psychological barrier. Once we break through $100, the mainstream will wake up. It will be on the cover of major publications. It will be the top story on every network. And then the real mania begins. Now let me bring you back to ground level, because all of that analysis is meaningless if you cannot actually buy the metal. Let us talk about what happens when you try to walk into a dealer today. While the ticker says $85, your dealer is telling you a completely different story. The price on the screen is an illusion. The price on your receipt is reality. If you want to buy a 1-ounce silver coin today, you are not paying $85. So you are paying a premium we have not seen since the peak of the pandemic. The markups on standard coins have exploded to $9, $10, even $12 per ounce above spot. Do the math. $85 spot price plus $10 premium equals $95. Does that number look familiar? That is almost exactly what buyers in Shanghai are paying. The physical market has already repriced itself. The only thing still lagging behind is the manipulable paper contract on the exchange. But the price is only half of the problem. The real issue is availability. We have confirmed reports from major mints that delivery times for new orders are now at 8 weeks. When a dealer tells you to pay today for delivery in 2 months, he is not selling you silver. He is selling you a futures contract. He is selling you hope. That is the definition of a physical default at the retail level. One leading precious metals dealer in the United States described the situation in an internal communication this morning with 3 words: nobody has silver. He warned further that if this buying panic continues, premiums could rise to $20, $30, or even $50 above spot. Think carefully about what that means. The banks can push the paper price at the exchange down to $70 if they want. But if the physical premium rises to $50, you are still paying $120 for the ounce. A bifurcated market emerges. The paper price becomes fiction. You cannot print physical metal. You cannot short a silver coin into existence. We are entering the unobtainium phase. The price on the tag does not matter when the shelf is empty. And people are realizing they are trapped. They see inflation destroying their purchasing power. They see the banking system under pressure, and they want out of paper. They want into real assets before the door closes. The door is tiny, and everyone is trying to get through it at the same time. If you can still find physical silver, do not hesitate because of the premium. Is it better to pay $10 over spot and hold the metal in your hand, or to wait for the premium to come down and discover there is nothing left to buy? And before we close, there is one more factor that most analysts are completely ignoring: the geopolitical dimension. Look at where silver comes from. The largest silver-producing nations in the world are Mexico, Peru, and China. And right here, the next storm is brewing. We are entering an era of resource nationalism. Countries that have silver are going to stop exporting it. Why would Mexico or Peru sell their precious silver for rapidly depreciating dollars when they need it for their own industrial futures? We are already seeing the early signs: export restrictions, nationalization of mines, strategic reserves being built. Imagine Mexico announces tomorrow that no silver will be sold to foreign buyers. What happens to the price then? It does not double. It becomes incalculable. There is no price for silver in dollars because there is no silver available for dollars. The United States and China will compete for every remaining ounce. This is no longer a trade war. This is a resource war, and you are standing in the middle of it. When governments begin confiscating metal or closing borders to exports, your window to buy is officially over. The exit strategy we have discussed, converting your silver into real productive assets, like land and income-producing property at the peak of the mania, only works while the market is still open. Once the resource lockdown begins, everything freezes. In a world of resource warfare, physical possession is the only law that matters. What you have witnessed today is not a market event. It is a geological fault line between two financial worlds finally giving way. The paper world and the physical world could not agree on price, and when that happens, it is always the physical world that wins. Always. No contract, no algorithm, and no central bank has ever successfully repealed the laws of supply and demand forever. History does not remember the paper. History remembers who held the metal. And if this video showed you something that the financial media refuses to touch, do us one favor right now. Hit that subscribe button and ring the notification bell. Every single week we go deeper into the numbers, the geopolitics, and the real strategies that protect your family's wealth, while the mainstream is still looking the wrong direction. This channel is for the people who are done waiting to be told what is happening and ready to see it first. We will see you in the next one.